Crypto companies and hedge funds don't have a lot of options when it comes to banking. If you're starting a crypto company, many banks won't even accept you. If you're starting a crypto hedge fund, the situation is even worse. There are very, very few banks who are willing to work with you. And you need a bank because even if you're a crypto native company or a crypto native fund, you probably need to accept your investor deposits via a normal bank. On top of that, if you need to pay employees, you may be able to pay some of them with crypto. If you're going to pay vendors, you probably won't be able to pay them all with crypto. So you still need some access to the normal banking system. That's why Silvergate Capital is such an interesting company to look at, right? Recently, we've had a lot of implosions in the crypto industry. We had Three Arrows Capital, we had Voyager Digital, and Celsius Network more recently file for bankruptcy. Silvergate, being the bank for a great many crypto hedge funds and companies, is very interesting to look at because we can potentially see, do they report liquidations? Do they report a decreasing number of customers? What do they see in the crypto market since they are attached to the money flows that go between the normal banking system and the crypto industry? So Silvergate reported their earnings today, their second quarter 2022 earnings, and we're going to go over what they are seeing in the market and what their financial numbers are, because potentially Silvergate itself may be at risk of bankruptcy. So let's take a look. We go down here in the presentation, they have their basic stuff, digital currency customers increasing. That's a good thing to see, right? So even if they're losing some customers, apparently they're still growing them on average and at a semi-meaningful rate, right? If we look at from Q1 2022 to Q2 2022, from 1503 to 1585, that's, it's not a tiny growth rate there, right? Let's see, that's what, 82 on 1503. 82 on 1503. That is 5.5% essentially. So 5.5% growth rate in one quarter during a bear market. That to me indicates that crypto as an industry, despite all of the problems that are going on, is still growing. There are still more companies that are being created in the crypto space, more companies that are getting into crypto. So that's very interesting to see. That's a good sign for the crypto market's longevity. Now, transaction revenue has definitely dropped, but most of that drop actually happened from Q2 to Q3 of last year. So in Q2 of last year, we had 11.3 million in transaction revenue, which dropped to 8.1. We're actually a little bit above that now, although we've been more or less pretty flat for the past 4 quarters. If we look at crypto industry trends, we see the dollar trading volume is down pretty substantially by about half. That's, definitely to be expected, if for no other reason the fact that the crypto market has dropped by half or more. And this is dollar trading volume, right? So the fact that, we've seen Bitcoin and Ethereum fall much more than 50%, you'd almost expect this drop to be even larger than it is. So this is, if anything, indicates that perhaps a bit more trading in crypto denominated terms, even if not in dollar terms, might be happening. So that's interesting to see. Here we have their net income attributable to common shareholders, which is 35.9 million. An interesting thing to note is that Silvergate doesn't really trade like a bank. If you look at its financials and you look at its market cap, right, it trades much more like a tech stock than it does a bank. And that's because it's essentially heavily exposed to the crypto market, right? Crypto companies are sort of like tech on steroids in terms of their volatility. And because of that extreme volatility and extreme amount of risk, Silvergate, even though it's a bank, it has a lot of risk exposure via all of its customers. If 50% of the crypto companies went bankrupt, Silvergate would definitely suffer. So for that reason, it has a lot of risk, but it also has a lot of premium, right? If you look at its PE ratio, for example. So for a company that, makes under $36 million a year in income, it sure has a pretty high market cap. Revenue is a bit higher, right? Revenue is just under 80 million. Tier 1 leverage ratio of 10.10%. This is a financial metric that banks report across the financial sector, so you can compare this. If I remember, I believe this is actually slightly higher than Ally Financial, so that's nice. Although I'd have to double check that. Diluted earnings per share of $1.13. Non-interest expense of 30.6 million. So That's not great because this doesn't even really include the cost of capital, but it's a non-interest expense, pretty high, 30.6 million. Total assets 15.8 billion, so not bad, growing plus 29%. Digital currency deposits looks like, so average digital currency deposits, this is interesting, right? So let's look at this in detail. We have the high and low of digital currency deposits are these light boxes. The average is this black line. So if we look at from Q1 2022 to this last quarter, Q2, the high went up, right? So from 16.2, we went up to a high of 17.6. That's despite having a lot of drawdown in the crypto market during Q1. However, the low is also lower than Q1, and the average is lower. So this likely means that, hey, we continue to go up a little bit into early Q2, but then we dropped back down. So it looks like on average, right, our digital currency deposits probably are going down a bit. Their commentary is that year-over-year increase in average digital currency deposits was driven by growth in deposits from existing customers and the addition of 361 net new customers. The annualized cost of deposits was 0% in Q2, reflecting the company's digital currency deposit gathering strategy. Okay, so that doesn't actually tell us too much about timing of what's happening within this Q2. So let's keep going. Asset composition. So we have securities composition, US Treasuries at 10.8%, US agency securities at 12.5%, municipal bonds 27.7%, asset-backed securities very small. So these would be like mortgages, for example. Mortgage-backed securities would fall into this category. Oh, actually, no, I guess they've separated that out. So here we have mortgage-backed securities over here, included in this residential category, 31.6%. So I'm not sure, yeah, this would be more exotic, I suppose, asset-backed securities. And then we have commercial mortgage-backed securities, et cetera, at 15.6%. So we still do have a large exposure to the real estate sector here. That's sort of unfortunate because the real estate sector is coming under some pressure. Just the other day, I was talking to a realtor who is also an investor and pretty plugged into the real estate market in North Carolina. And they were saying that they saw some institutional pullout. So last year, there were many institutional customers that were buying, as many know. It hit mainstream headlines. There was a lot of talk about BlackRock, although it's not, that was misinformation. It wasn't actually BlackRock. It was other institutions that were buying up a lot of single-family homes and other residential real estate. However, some of those companies have now started to sell off their real estate. And that is very interesting because real estate has high transactional costs, right? You have to pay commissions. When you both buy and sell real estate, you have to pay title fees, inspection fees, etc. So it can easily come out to be, 5 to 10% even of the cost of the home when you're transacting, right? So if you, let's say, lose 5% when you buy the home and you lose another 5% when you sell it, that's 10%. To sell it, to buy 1 year and sell the next, like housing prices have gone up, but they're essentially giving up most or all of those gains, in that 10% friction cost of buying and selling so quickly. So, they probably came out a little bit ahead. They collected a bit of rent and housing prices really ramped up in the last year. But it's interesting that, the fact that they're willing to sell means that they likely anticipate, underperformance in the near future. They anticipate some drops that are, bigger than the cost of those transaction fees. So that doesn't bode too well for the residential housing market going forward. And so it's interesting to look at Silvergate because, not only are they exposed to crypto, but they also have a pretty substantial exposure here to real estate, both commercial and residential. So that's something to keep an eye on as a risk factor. Net interest income and margin. We have basically net interest income before provision steadily increasing. Net interest margin steadily going up, but it looks like it's pretty much in we're approaching 2% now. A loan composition, 9% of total assets. So real estate and other at 10.6%. SEN leverage. So SEN is a special platform that's specific to Silvergate. It's a crypto-related platform. That's at 20.6%. So that's interesting. I'd be interested in what the character of this leverage is whether this is sort of direct trading leverage or whether this is like settlement leverage. In either case, this is a risk factor as we have a lot of volatility in the crypto markets. And then mortgage warehouse, 68.8%, so big chunk there. Commentary, 55% of securities were floating rate. That's good if they own those securities. It's bad if they owe those securities. High quality securities portfolio with 97% rated AA minus or better. 88% of loans held for investment were floating rate. Okay, so that's interesting to note. That's actually pretty high for a bank. 88%. I guess that's because they're not necessarily lending out as much to real estate as an average bank would. So they're able to collect that floating rate interest. So often you'll see that banks, for example, Ally had their earnings call earlier today, and they were talking about how, as interest rates rise, essentially their liabilities are jumping before their assets do. So maybe they already wrote some 30-year mortgages at a lower interest rate, and those were 30-year fixed, right? So they're still going to, if they wrote a 30-year fixed mortgage at 5%, they're still only going to collect it at 5%, even though prevailing interest rates for mortgages might have gone higher than that. So they're kind of stuck usually, and many banks are in this predicament where it's like if they're heavily exposed to mortgages or car loans even, then they can have it where they underwrite these long-term loans at low interest rates, then interest rates rise, and they have to pay a higher cost of capital, but they don't receive any higher cost of returns on their capital. So that's sort of a problem with banks and finance lenders in general. However, it does appear that Silvergate has a better setup here, right? 88% of their loans were floating rate. So that means that they have much more, they're much more naturally nimble in the interest rate environment. If interest rates go up, then, Silvergate has to pay more for their money, but they also get paid more to lend that money out. So it auto adjusts, at least 88% of their business does, which is pretty nice for them. That's a nice safety factor built in there. For each 25 basis point increase in interest rates, net interest income is estimated to increase approximately $16 million over a 12-month period. That's interesting. That's based on a static balance sheet rate shock. If you look at non-interest income, we have fee income from digital currency customers in black. So we can see that is definitely the biggest chunk here. This is interesting. What's going on in Q3? Other in non-interest income net, I would guess that this is probably something to do with reserves. So bank accounting, one of the very basic things about bank accounting is that banks have these credit loss reserve funds, and they can put more money into the credit loss reserve fund if they expect more delinquencies, more defaults in the future. That would be like, so if they expect the economy to get worse, or in this case, if Silvergate expects the crypto market to get worse, then they could increase those credit provisions. If they think things will get better in the future, they can reduce them. That's a non-cash expense, but it's one of the biggest things that can affect bank earnings. So here, right, I would expect that probably what happened here is that they took out a big chunk from their loss provisions, and that's why you have this, huge apparent net income, which is probably not a cash income. It's not real income in that sense. It's just, hey, we don't expect as much loss in the future, so we're taking some out of our reserves. The reason that this is so tiny here is I would almost expect that we might be even adding to it, although that's not necessarily the case, because there's also transaction income and just general bank fees that'll fall into this category. But yeah, I wouldn't be expected if they're currently adding to the reserves. We know that many other banks and lending companies are. Commentary, second quarter 2022 fee income from digital currency customers remained relatively stable compared to the prior quarter. So that's interesting. Fee income makes sense as long as that customer is banking with Silvergate, the fee income should be relatively stable. Other non-interest income consists primarily of mortgage warehouse fee income and other gains and losses on the sale of securities, as well as interest rate derivatives. Non-interest expense. So here we have the flip side of that. Not what Silvergate is paying for their capital, but what they're paying for everything else. Looks like we have 4 categories. So sales/employee benefits. Those have grown pretty substantially, actually. It looks like we've increased about 60% from the same time last year. Communication/data, that has also increased from 1.8 to 3, so maybe 40-50%, something like that. Pretty notable increase there. Our professional services, so that would be like legal services, consulting services, accounting services, etc. That's gone from 2.6 up to 6.3, so also pretty substantially up there. And then we have other, which is the only thing that's gone down, 6.9 down to 4.9. I'm curious what that is actually. So what have they lumped into this other category? Because all of the 3 specific categories of expenses have increased, but the other categories actually decreased, and I wonder why. Second quarter, non-interest expense up 9% versus Q1. So that's just quarter over quarter. We're up 9%. That's pretty meaningful. 42% versus last year. And most of that is attributable to salaries/employee benefits and professional services. So they say that's due to ongoing investments in strategic growth initiatives. Other primary includes FDIC insurance expense. We do know that FDIC expenses are going up for some banks. 1.6 million reversal of provision for off-balance sheet SEN leverage commitments. Full year 2022 non-interest expense expected to be approximately 130 to 140 million, including intangible amortization. So that might be what is partly included in here. Amortization is basically you have an intangible asset. So let's say that Silvergate acquired another company for more than the book value of that company. And the difference between the acquiring price and the book price is called goodwill, which is just an accounting trick. It's not a real thing. It's just an accounting trick to account for that difference in value. And then each year you can write off a certain amount of that amortization. You can amortize it, basically, is what it's called. So it may have been that they acquired something back here that they were amortizing, and then the amortization has decreased. That might be why we're seeing a lower expense up here. Network effects, let's skip over that. Okay, so that's all they've given us in the presentation. Let's go over to their release here. So we have this specific financial data. So net income as of June 30th at 38.6 million versus same time last year, 20.9 million. So net income up pretty substantially. We've almost doubled income, so that's good to see, right? Because we increased those salaries and benefits about 60%, but we've actually almost doubled the net income. So we are growing net income faster than our expenses, it looks like, even salary expenses. So that's very nice to see. That's different than, all of the sort of mainstream banks that we've heard their earnings so far in this quarter. Net income attributable to shareholders, pretty similar there. Diluted earnings per share is up. That's also very nice because sometimes you can have a company that increases their net income substantially, but they might also be issuing more shares or doing a lot of acquisitions that dilute existing shareholders. But we actually have a pretty substantial increase here. Let's see. $1.13 over 113 over 80. That is 41% increase. So we're up 41% in terms of earnings per share year on year. That is an impressive growth rate. Return on average assets last year it was 0.77%. Now it's 0.9%. That is actually not that great. This number I ideally would like this to be over 1%. So it's kind of strange actually that this company is growing so fast, and yet their return on assets is not actually very good. I kind of wonder what exactly is going on there, if that's just due to, something I want to look into. That's kind of curious, actually. I would have expected more from them. Anyway, return on average common equity. This also is not very good, actually. If you compare to JP Morgan, Morgan Stanley, Ally, banks generally have been doing a lot better than this. So this is kind of unfortunate. It doesn't, I'm not actually very impressed by this number either. And return on equity is a pretty important metric. It basically is, ROI is return on investment. So that would be, if you buy a stock at a certain, let's say $100 and it goes up to $120, you have a 20% ROI. But if you want to actually judge the long-term performance of a company, and you want to say, how good is the management of this company? Well, the company doesn't have access to the full amount of the market cap, right? So, the market cap of a company might be, 100 billion. And, if you go from 100 billion market cap to 120 billion market cap, you're like, hey, we have a 20% ROI, right? But that's not a good way to judge the management of the company, because maybe that's just investors, guessing, right? It's investors valuing something. They're saying, hey, we have a tiny amount of growth, but there's nothing else that's growing, so we're going to put a bunch of money in this, and that pushes up the market cap. If you want to get a better idea of what the management is actually doing, return on equity says, hey, look at the balance sheet and calculate the equity of the company, the shareholder equity. It's a metric, it's a financial metric. And then you can say, okay, from one, period to the next, how much does that equity increase? And that is the return on equity, that increase divided by that initial equity. That's the ROE, return on equity. So ROI is very variable. It's dependent on a lot of things, a lot of macro conditions and trader sentiment, etc. But ROE is much more robust in terms of being a reliable metric for seeing what the company is doing. If the company starts with, let's say in that same example, right? Let's say it has a $100 billion market cap. Maybe the shareholder equity is only 50 billion, right? And then it goes to 70 billion. So if the market cap goes from, 100 billion to 120, and the equity goes from 50 to 70, then the ROE is actually a lot higher than the ROI. And so that means that, actually this management is doing pretty fantastic, right? 20 on 50 is 40%. So that would be a 40% ROE. That's ridiculous. Like almost no companies have that unless they're, small startups. But that gives you an idea of what's going on here. So this basically says that the shareholder equity of the company, right, it's actually not increasing very fast. It's like 10%. Even last, in the first quarter, I mean, granted, there was a lot of, crypto decline here. So it's only, somewhat fair that should be lower. But yeah, it's not quite as good as I would have hoped it would be. Net interest margin, that's decent. That's okay. Cost of deposits, great, 0%. Cost of funds, very low. Efficiency ratio, looks like that has been steadily dropping since last year. Total assets, we're at just about 15.8 billion. Pretty steady across these past 2 quarters here. We are up from last year despite crypto coming down, so that is a strong sign of continued growth there. And then we have our tier 1 leverage ratio, which is a standard financial metric for banks. Regulatory importance, it looks like we were actually pretty low last year. That's kind of interesting, and we've actually increased, so that's a good sign. I would have expected this to be going the other direction, given that the crypto market's just been crumbling. But the fact that we've gone up means they're actually, they're solidifying their financial position a bit. They're becoming a little bit of a stronger company. Total risk-based capital ratio, looks like those have stayed relatively constant over the last year. If we look at the digital currency initiative section here, it says at June 30th, the company's digital currency customers increased from 1585 to 1503. We talked about that. From 1224 last year. As of June 30th, prospective digital currency customer leads in various stages of the customer onboarding process and pipeline were above 300. So they have a robust pipeline of new customers coming in. For the second quarter of 2022, 191.3 billion of US dollar transfers occurred on the SEN platform, a 34% increase from the first quarter of 2022. That's also impressive. A decrease of 20% though compared to the second quarter of 2021. So that SEN platform has decreased a bit, which, given how crazy everything was in 2021, that's not that much of a surprise. But and even so, right, decreased 20%. Again, the crypto market's dropped a lot more than that, so it's not bad. Let's go down to the balance sheet. Here we go. All right, so yeah, let's look at the balance sheet. Let's see what's going on here, because this is where you see really what is the true health of this company. So we have interest earning deposits in other banks. This is at 1.5 billion roughly. So that's about a tenth of their total assets. We have taxable securities. So this will be like bonds, various sort mortgages, government treasuries, etc. This is about 9 billion. Tax exempt securities. So this is going to be mostly municipal bonds. This is about 3 billion. And then loans, we have about 1.7 billion. Other, yeah, it's small down here. So total interest earning assets, total non-interest earning assets. Yeah, most of these are interest earning, so that's good. Yeah, this is interesting. I wonder if they're gonna break this down more. That would be nice. Let's look at liabilities and shareholder equity. So in interest-bearing deposits, we have 68 million roughly. Is that right? Interesting. Yeah, 68 million basically. Wow, that's much smaller than I would have guessed. I'm guessing must be that most of their accounts are not interest bearing. Still, yeah, that's pretty small. I mean, it's good for them. I'm just kind of surprised. We have FHLB advances and other borrowings. This is about 400 million. Subordinated debentures. Yeah, all of this total interest-bearing liabilities are only about 482 million. Non-interest bearing deposits. Yeah, wow, that is crazy. So, I mean, that's amazing for them, right? It's an amazing business. They're essentially getting, yeah, zero cost of capital on $14 billion. And I'm guessing, the reason that they can probably pull this off is just the fact that they're one of the very few players who are willing to bank crypto customers. So if you're a crypto company, you're happy just to get an account. You don't even demand interest because you're just like, hey, I'm going to earn interest from yield farming, or even if I don't earn interest from that, I have to have a bank account to run my business. And so just, that's probably some monopoly effect here. They have a very few competitors. And so they can just, they can give you zero money and hold your deposits. So it's a great business for sort of Silvergate. That's kind of awesome for them. Other liabilities, small again. So yeah, this is by far the biggest thing here. It's just the biggest liability they have is just this $14 billion chunk of non-interest bearing assets. Or yeah, non-interest bearing deposits. Amazing. And then shareholder equity of about 1.5 billion. So interesting. Let's look real quick at what is Silvergate's market cap? So I'm not sure if this is accurate, but according to Yahoo Finance, it says we have a $2 billion market cap. So there is a bit of a premium. It looks like, we have about a 33% premium that you're paying over the book value of this company. So not too bad. Let's go down more. Non-interest, yeah, none of these numbers are that big. So yeah, I don't see anything that's too bad here. Of course, the big thing is these taxable securities. Like, what are these taxable securities exactly? How does this break down? What is the exact exposure to different sections of the crypto market? That would be nice to see, to get a better idea of the robustness of their balance sheet. But as it is, we'll take what we can get. What I see here looks not bad. Non-interest income. So this is a little statement of their income. Deposit related fees. Definitely the biggest chunk of non-interest income. That's very nice. That's a solid, this is a very safe kind of income, right? It's not going to vary, depending on ups, downs of the market, whatever. This is going to stay pretty solid. So that's pretty nice. If we go down here to the non-interest expenses, salaries and employee benefits, definitely this biggest chunk here, by far the most important. It's over half of the total non-interest expense. We have occupancy and equipment. That has gone up a bit. Let's see, what is the second biggest one though? Just the professional services. Yeah, and we already looked at this out, so it doesn't actually break this down anymore. So let's see if there's anything else that's new here. This is interesting, breaking down the type of customers that Silvergate has. Digital currency exchanges. How many digital currency exchanges are customers of Silvergate? It looks like we have 102. That's nuts, right? Do you guys even know of 102 digital currency exchanges? I mean, it seems like there's so many of them, but yeah, that's kind of astonishing. That's a lot. It's a lot of digital currency exchanges. 102. I can't think of 102 off the top of my head, the names of them. And that's actually up from last quarter. So it looks like we have a net, like we have 6 additional exchanges that have listed since last quarter, despite how bad Q1 was. So that's interesting. Institutional investors also has increased. We went from 966 institutional customers to 1,017. And other customers are increased. It also looks like the deposits for the digital currency exchanges is up. Also up for institutional investors. It's down for other customers though. So I'm guessing this would be, right, these would be non-currency exchange businesses in the crypto space. That's my guess. Potentially some companies that are just, you know, peripherally dabbling in crypto. But yeah, I mean, these are impressive growth numbers to have in a bear market of crypto. And that, I think, oh, here we go. Actually, let's look at the loan portfolio. Here we have real estate loans, breaking down all of that. Can we see more than just real estate? Non-accrual loans, asset quality ratios. Yeah, what I really want to see is a discussion about crypto loans, but I'm not sure if they're going to give that to me. Non-interest-bearing demand accounts, subordinated debentures, preferred stock, retained earnings. Yeah, I'm not seeing what I really want to see here. Nope, and that's it. All right, guys, well, that is all we have for today then. So if you like this, hit the like button, and I'll see you guys next time.